This week is definitely Fed week, and the Federal Reserve is sending tremors through the main markets and crypto. Are we seeing a strengthening or weakening in global outlook? Can the stock market and crypto pick up from here? The Fed and the FOMC has markets on a razor's edge. We're going to examine the content from the speeches from Loretta J. Mester. Also, we're going to look at Brainard's speech, and then we're going to look at Barr's speech, and finally revisit Powell's speech on August the 26th. We're going to look at key statistics. We're going to get a view on what the Fed is looking for, and we'll be looking through the markets to try to understand what could happen next. We need to prepare ourselves for whatever price action could come from this, be it downwards or upwards. Have we actually found the bottom, or is there more room to go? Stay tuned, it's going to be awesome. Hi everyone, I'm Ken from CryptoTradingKS, and the inventor of the CTKS method and BORSOG trading. If you're new, a very warm welcome, and welcome back KS family. From my 30 plus years in financial markets, I explain the smart money mindset to assist you to be more of a financial blessing to yourself and those you love, gaining real wealth and positive excellence in the process. Let's run the numbers. Bitcoin is currently up 1.75% to 19,155. Ethereum is up 5.75% to 1608. Please keep yourself safe from scammers. I don't have WhatsApp or Telegram. As crypto technical analysts, we look everywhere outside the crypto market, inside ourselves. We're actually really good detectives. The first thing that we do is to mark up our charts with the CTKS method. Next, we look outside the crypto market, taking the macroeconomic picture very seriously. Then we move back inside the crypto market, enhancing our pattern recognition, because crypto is an exponential market. Before we buy or sell, we must master emotional control. If we don't do that, we will subject ourselves to losses, not just financially, but personally and emotionally. It was a really interesting trading session in the last session. Since Mester, Brainard, and Barr spoke, the percentage probability increase of a 75 basis point rise in the federal funds rate actually has increased. But what's really interesting about this, the markets also rallied. And we've seen this many times before on Fed announcements. We tend to get a bit of a spike up and then a sell-off after. We'll do these FOMC member speeches in order, starting with Mester. Reporters tend to be extremely busy people and just basically cherry pick different points of view from a speech. We do something completely different. We analyze the entire speech. One thing that you will notice with all these FOMC member speeches, they all say the same thing. Of course, the views I present will be my own and not necessarily those of the Federal Reserve System or my colleagues on the Federal Open Market Committee, the FOMC. What about Vice Chair Brainard? What about these comments that are made here? Well, let's go and have a look at the footnote, shall we? These views are my own. Oh, it's a Gary Gensler. And what about the Vice Chair for Supervision, Michael Barr? What are we seeing here? Well, do we see a consistent footnote? Whoa, there it is again. These views expressed here are my own and do not necessarily reflect those of the Federal Reserve Board or the FOMC. I'm really impressed that Jerome Powell, when he did his speech on August 26th, he didn't have one of those disclaimers. Let's have a look at the speech by Loretta Mester. There's some really important terms in this that I want you to truly understand. When we read economic news at first sight, it could be really confusing. And you may say, what does that mean? Let's have a look. Unacceptably high inflation is being caused by an imbalance. And this is what the Fed wants to fix, the imbalance between strong demand and constrained supply. What does constrained supply mean? Well, people are demanding a lot but getting very little, so they're bidding up the price, which has now become the #1 concern of businesses and households. Price stability is definitely the foundation of a strong economy. One thing that you will find when inflation goes out of control, nothing works. The Fed's actions through the FOMC is to bring inflation back to the longer run goal of 2%. Notice that these words are really important, taking decisive action to remove monetary policy accommodation. That means they're going to bring their balance sheet down and raise interest rates. They can't fix the supply side of the economy, but they can sure destroy demand. Loretta says, I believe the Fed has more work to do in order to get inflation under control, which means they're not getting there. They're not getting it under control. And this speech is all about further rate increases and tighter financial conditions will have to happen. And this could actually transition the economy to below trend growth in nominal output, cause unemployment or slower employment growth as well. Economic growth is continuing to slow down. Consumer spending, housing activity, and business investment have decelerated from last year. One thing that's really important in what Loretta says, I do not believe the US economy is currently in a recession because the labor market is so strong. To understand this statistically, we need to actually look at another speech, actually Brainard's speech, and a key figure, figure 5, ratio of job openings to unemployed. What this basically means, there are 2 job openings available for every single unemployed person. This is pretty staggering, and you can see that the job market is so buoyant at the moment that it's way above the pre-pandemic peak. But you can see it's actually increasing. There's some pretty interesting dynamics happening inside labor markets. We can see employment levels have recovered and they're marching forward. We can see the average weeks unemployed is 22.3 weeks, but that's coming down. It used to be 31.6 up at the peak here. We can see job openings in manufacturing and the private sector are actually increasing, but they're starting to roll over in the private sector, but they're still high. And when we look at employed full-time weekly median real earnings, they're falling. People in real terms, that is money after inflation, they're going backwards. In fact, their paychecks are about 3 years old. They're about the same level as they were monetarily in terms of purchasing power for 2019. Hence, when you see things like this, the labor market is so strong. I want you to picture those charts. And note, I do believe that the risks of recession over the next 2 years have moved up. But this is just a personal opinion. This is not the opinion of the Fed. I believe what happened in the last trading session, people just caught a glimpse of, oh, the recession is ages away. Let's go all in and more. So Loretta has not incorporated a recession into her baseline outlook for the next FOMC meeting in 2 weeks. And she expects that the US economy will return to positive growth in the second half of the year. That's actually pretty good news. And by the way, coincides with what? You got it, midterm elections. Again, another reason for market participants to say woohoo. With the economy growing below trend, Loretta expects labor market conditions to cool, unemployment rates to rise above 4% by the end of next year. And the employment report for August showed that there was some moderation in labor market conditions. Loretta says that the increase in the unemployment rate partly reflects an increase in labor force participation, which basically means people that have decided to come back and look for work. And the concept, if more people participate, look for work, that's going to help the imbalance because there'll be a greater pool of people to look for work, and therefore that particular statistic will fall. Statistic, you say? What statistic, Ken? What is that? For example, if there were 10 people and there were 20 jobs, that would mean a ratio of job openings to unemployed. Well, that's 2. But what happens if participation actually increases? It doubles from 10 to 20. Well, it comes down to one. That's what the economists want. They want to run the numbers. Labour demand is still outpacing labour supply. There's still almost double the number of openings per unemployed worker, and you have the graph. You know exactly what she's talking about. To put this into perspective, in 2019, another time of tight labour markets, there was only about 1.2 openings per unemployed worker. So 2 to 1 is pretty full on. And you know from the other chart I showed you, this particular one, employed full-time weekly median real earnings, that is falling. Even though it's really difficult to find people to work, so all sorts of things are happening to attract and retain people. Wage increases have not kept up with inflation because purchasing power is being eroded. And you can see a chart, you've just seen one, that shows you that in real time. Inflation is the highest it's been for 40 years. And the concept that it's actually peaked, Loretta is saying, I don't believe that. Why? Why doesn't she believe it? Ongoing war in Ukraine. Gas and energy prices may move higher again later this year. Persistent services inflation. And stickier things, more lag things like housing rent and shelter costs are likely to be elevated for some time. Absolutely they are. Another reason the markets may have rallied, but I do expect inflation to move down into a 5 to 6% range for this year. And then the Fed's just going to keep on doing its magic and make inflation go down more and more. Because how are they going to do that? They can't touch the supply side of the argument. They have to go for demand destruction. It's the only thing that they have. And Loretta says that exactly. When it comes to price stability and maximum employment, the FOMC and the Fed needs to work on the demand side of the economy. Monetary policy cannot affect the supply side factors that have contributed to very high inflation readings. And a lot of people have said, Ken, what about the Fed just raising interest rates? For example, the federal funds rate, the benchmark interest rate in the US economy, you can look at it that way, has been just going parabolic. Surely this can fix inflation. No, the root cause of inflation is something else. It's the fact that economies worldwide have outsourced, and when the pandemic came along, all the supply chains fell to pieces. One really big issue is the forward inflation rates. The Fed must bring those down. They must. Absolutely must, and Jerome Powell has been very precise about it. Masterclass students, you get my live chart in TM4. Have a look at this. This is very interesting and could throw some very good signals for your trading and investing. When we look at the 10-year break-even inflation rate and the 5-year break-even inflation rate, what are these rates? They're expected inflation 5 years out and 10 years out. Look how they came up, flattened and went down. Came up, flattened and went down. What did the NASDAQ do? It did the polar opposite. It did the inverse. So this is really important to keep on your mind, keep on your radar. So what are we actually seeing? The Fed balance sheet continues to decrease. Loretta is basically saying that annual inflation, well, it's too early to say that it's peaked. But one thing is for sure, keep your eye on the 10-year and the 5-year. One really interesting thing right in here, Loretta says, you know, those mortgage-backed securities, we don't want them anymore. We just want Treasury securities. In the comments, please let me know, what do you think this means? It's actually a really important concept, and as a community, we're always doing active learning. This paragraph basically says that monetary policy takes time to get or hit the economy, and it's always the case. So there's a time where the full effect will be hit, but it's not right now. So further increases in policy rates are required. I just did a refresh. The federal funds rate, the probability of a 75 basis point increase in the next FOMC meeting has jumped to 82%. I said quite a few weeks ago, I believe statistically, probabilistically, that we will see 100 basis point graph emerge here. It may not be the one that's taken, but the concept is, I believe it will emerge. And what does this mean? If, for example, the federal funds rate is increased by 75 basis points, it makes the cost of money so much more expensive, and that stops people from taking things like investments or loans. It also incentivizes people to actually save money. The real problem is the market expects a 50 basis point increase, and after Fed Powell came out on August the 26th, Jerome said that the thing that they have to fix is rational inattention. I didn't see this be mentioned by any mainstream media, any press source, but this is the concept, this is the key thing that the Fed chairman needs to fix. And what is rational inattention? It's all about the concept. When people think that inflation is just going to be persistent, they bake it into their decisions. And that's not what is good for the economic system. The Fed has to kill that concept. So the Fed will need to move policy into restrictive stance. It's not in one already, it's certainly in one. This kind of gives you the concept. We will need to move. It means they're not doing it yet. And this is really important for people to understand. Loretta's view is that the nominal federal funds rate will need to be above 4%. What is it now? The nominal federal funds rate is 2.33% right now. Loretta wants it above 4%. When is this going to happen? By early next year. A lot of people have been talking about a Fed pivot, which is where the federal funds rate starts to drop and things get easier. The balance sheet starts to increase. That's not on the table. I've seen this particular statement thrown around a variety of media sources. The size of rate increases at any particular FOMC meeting and the peak federal funds rate will depend on the inflation outlook, which depends on the assessment of how rapidly aggregate demand and supply are coming back into better balance and price pressures are being reduced. I believe this statement is the weakest part of this speech. What they're basically saying here, they need to do whatever they need to do to get inflation under control. They can't fix the war in Ukraine. They can't fix the energy situation in Europe. They can't fix the global economic outlook. They can't fix that headline inflation is just going rampant all over the place. They can't fix that the growth, for example, in residential investment is starting to fall. They can't fix so many things. And if you look at real personal consumption expenditure, it's been ramping up. But with interest rates on the rise, people will actually be fearful of spending. They're likely to save, not spend. In these speeches, they've argued a lot that motor vehicles were pretty much to blame because they were just going parabolic in terms of inflated prices. So we can basically see that the Fed doesn't believe that inflation has peaked, and they'll require a lot of months of data to actually convince them otherwise. The Fed is going to be carefully watching measures of inflation, including expectations of inflation. We look at that just about every other day. That's what the 10-year and the 5-year break-even inflation rate actually represent, those forward expectations. It's important to keep your eyes on these two statistics. They're also sending various coded messages that policymakers can't be complacent in any way. And they're going to have to act forcibly to bring down inflation and also the expectations of inflation. And what is the coded Fed speech saying? The return to price stability will take some time, which means it's going to be a lot of pain in the economy for quite a while, and a lot of fortitude, which means a lot of people are going to get hurt. And this is a key thing for us. Financial markets could well remain volatile. That volatility, as a trader, you can do incredibly well at. The markets are becoming more and more. If you have any expectations that there will be a reversal of the Fed's position, They will just create a loose monetary policy and say, hey, go for it. We're just going to fund the economy. Don't think it. They also say, if we fail to take decisive action to get inflation down and firmly anchor inflation expectations, we will not be able to sustain healthy labour markets. I spent quite a bit of time on Loretta's speech because it's pretty much what they all say. They just take a little bit of a different angle on it. So doing one speech does all three. You can see the same words being reflected in Brainard's speech. Brainard talks about food and gas inflation. And one statistic here is very troubling. Low-income families spend about 75% of their income on necessities such as food, gas and shelter. And that's compared to 31% for high-income households. Inflation is really hitting a lot of people very, very hard. Brainard agrees with Master that it's all about watching over multiple periods of statistical analysis before any easing could even be considered. And you can see labour demand is very, very strong because there's so many job openings. And the current high level of job openings relative to job seekers remains close to the largest in post-war history, consistent with a tight labour market. Another thing, that could have caused the markets to do some kind of little mini rally. This may mean that the slowing aggregate demand will lead to a smaller increase in unemployment that we have seen in previous recessions. They're saying a recession is coming. Remember, I talked about previously the concept of treasuries making up the balance sheet of the Fed. Have a look at this. Increased policy rates, pace of balance sheet shrinking could put downward pressure on aggregate demand, particularly in interest-sensitive sectors like housing. And that's like something to do with mortgage-backed securities, correct? The Fed is putting it on the radar that the housing sector is going to get hit. One thing that Brainard said, which is really, really good, at some point in the tightening cycle, the risks will become more two-sided. What does that mean? What does that mean, you say? Well, basically it means that the pain will outweigh the benefit, so they need to be careful, but they can't pull back too soon. They have to let it run its course. And again, we get this inflation expectations. They're all focused on exactly the same thing. And they all say, we have no control over the supply shocks to food, energy, labor, or semiconductors. They're using the tool that they have, which is to increase the price of money. And they're going to need to raise that price up further by increasing the federal funds rate. Again, we hear this path of policy will be data dependent. Michael Barr, as Vice Chair for Supervision of the Board of Governors of the Federal Reserve, said one of his top goals is to make the financial system safer and also to make it fairer, especially to protect the economically vulnerable. To make financial systems stable, they have capital adequacy requirement ratios and a wide variety of different things that make money available if there are problems. What he's seeking to do is to actually ensure that if any large firms get into trouble, they can be resolved without costly bailouts and the taxpayers bearing the costs. They want the businesses to bear the costs. Another unexpected source of inflation can actually be mergers. When you have mergers, a big company swallows up all the little competitors, and of course it becomes much more powerful in setting its own prices. One thing of particular note to the crypto industry, they're focusing on stablecoins. And they want those stablecoins inside the prudential regulatory perimeter. They want them to be subject to the same oversight as the banking system. Michael believes that innovation fits into the financial system and makes it fairer. And if you're thinking Fed now is going to get a Guernsey, a seat at the table, you're correct. What does Michael say? Because one of the risks, of course, of these crypto assets, these pesky cryptos, And it's such a volatile market, it requires oversight so people are fully aware of the risks they face. I would ask a question. With all the regulation in the stock market, are people fully aware of the risks inside the stock market? After 30 years in financial markets, I would give you a resounding no. But there's going to be a huge amount of money in crypto, and the governments want to get their fingers on it, of course. With a declining tax base and rising pension payouts, they have to do something. And the key to understand, they're going to bring crypto inside the financial system. They're not going to outlaw it. It's too profitable. So we plan to work with other bank regulatory agencies to ensure that crypto activity inside banks is well regulated, based on the principle of same risk, same activity, same regulation, regardless of the technology used for the activity. So where's the FedNow carrot? At a more basic level, we need to focus on access to fast, efficient digital payments. Low-income households cannot afford to wait days for their income checks to clear, nor can small businesses, and that's pretty fair. A 3-day payment delay is an annoyance to someone with a savings account and ample credit, but it's a costly burden and a serious problem for others. What is the way that the Fed will fix this? By creating financial inclusion through the FedNow service. What exactly is the FedNow service? Launching in 2023, the FedNow service is an instant payment service that allows people to send and receive instant payments and gain full access to funds immediately. Over 2 years ago, the Visual Capitalist did a beautiful analysis on all of the world's money and markets in one visualization. Check out this. This is very, very interesting. About 7% of the money supply is physical, 93% is non-physical. What does that actually mean? If there was any form of bank run, you would not be able to get your cash because it simply doesn't exist. And this was over 2 years ago. And this is very common throughout the entire world. All the banks, the central banks, and all countries throughout the world are facing the same problems. They need digital currency. But the thing is, they don't want to give it to crypto because they don't have their finger in that pie. One important thing that we need to talk about is Jerome Powell's last policy speech on monetary policy and price stability. That was in Jackson Hole on August the 26th. Jerome was very specific. To restore price stability, we'll need to use our tools forcefully. And with the labor market strong, that is a problem. And he notes something that I don't think a lot of people actually caught on to. July's increase in the target range was the second 75 basis point increase in as many meetings. I said then that another unusually large increase could be appropriate at our next meeting. What is an unusually large increase? Well, 75 basis points is becoming standard. What's unusual? That would be 100. There is not going to be a pivot because the key is to control the public's expectations about future inflation. If inflation feeds upon itself, things will just get more and more inflationary, and that will cause rational inattention. And that means that people will bake into their decision making the fact that inflation is just here to stay, and that expectation will cause inflation to be here and stay. So they need to break the back of those inflationary expectations. How are they actually going to achieve this? Because they need to act with resolve now. Take forceful and rapid steps to moderate demand. Remember, they can't deal with the supply side. All those shortages, they can't deal with it, but they can do demand destruction. So what do we anticipate that Fed Chair Powell will actually deliver to the market? We would anticipate that Mester, Brainard, Barr, all of those speeches would be actually contained in Powell's speech. And of course, when George and Waller speak as well, they'll just be reinforcing the message. And what is the message? They have to do anything and everything to bring inflation down. What happened when Fed Chairman Powell gave this particular speech to world markets? The world markets lost their support and went on a roller coaster down. We saw global markets selling off, and of course, that included the crypto industry as well. As crypto technical analysts, we're prepared and not scared. That's rule 252. That means we just play out all the scenarios with our ANF to determine what is going on. Could we see the Federal Reserve raising interest rates to a degree that we go through another GFC? Well, it's possible. Could it be something like this particular sort of cyan line here, where we get a 50% retracement? Yes, that could be. That was the oil price crisis in 1973 to 1978. But could we get something like in 1971, a bit of a drop and a repair? Yes, that is also on the cards. Could we get something like from the 1980s, well, early 1980 to 1985? Could we get something like this? Absolutely. The key is that the markets will be incredibly volatile. You need to synchronize in with the markets, and that's why we do BORSOG synchronization codes. We can see the VIX is still in an upward momentum. Yes, it definitely did come down, but it's on an uptrend. And we can see that the prices, for example, with the NASDAQ 100, they're still under resistance. They've just done nothing more than a technical bounce. Bond prices have done a technical bounce as well. Gold has done a technical bounce. The dollar hit resistance and backed off. And when we see yields, they're definitely going up. The good news is oil is starting to go down. That will definitely help with relieving inflationary pressures. And one thing that we've actually seen is an increase in junk bonds. And junk bonds can indicate that risk on is back. But this is very, very early, and there's a lot of selling pressure that this will have to overcome. We know that there's a lot of resistance in the US dollar or the Dixie, the DXY. And prices are just below this 109,913 resistance level. The drop in the dollar has absolutely helped platinum and palladium. You'll notice that often platinum moves first. It could be something good to keep your eye on. And what about the other side of the equation? Could we have found the bottom? When we look at 50-day averages and stocks above the 50-day, you can see that for a number of times, stocks were way, way below their 50-day moving average. And that generally hammered in a very good bottom. Did we actually see a bottom here? This is something to bear in mind. Or, for example, would something like this happen? There's a lot of scenarios, and trading is the best way out of all of them. The concept with investing, you want to buy and see your money appreciate in value over time. Trading is about, okay, when you get a lot of volatility inside the market, you can step out of the market, just hang on to your cash, and when things actually start to repair or intra, for example, there's so many opportunities when markets sell off. Many people don't understand it, but they're definitely there. And the Fed has been very, very clear that the markets are going to get very choppy. And we can see gold, because of the dollar's descent, gold has partied somewhat, but there is a lot of resistance around this 758 to 1770 mark. Just bear that in mind. Crypto is an incredibly volatile and risky asset class, which makes it very, very attractive to trading. The last time Jerome Powell spoke, we saw a big sell-off, not only in crypto, but in the main markets. Don't forget, crypto trades 24 hours a day. It can actually throw pre-signals as to what the markets, the main markets, may be doing. It's very, very powerful. We have to keep in mind there's very, very little support underneath this level. If we lose this level, it is literally the Armageddon line. And the last time we had this kind of setup, we had a massive drop. So we must be risk averse at the moment. What is the market currently telling us? It's telling us it's under resistance. We've seen nothing more than a movement back towards a resistance level, and this resistance level has been there for quite a while. This is nothing new in the market. It's not a sign that things have repaired. We're also seeing in Bitcoin's structure, market structure, and it's currently trading at 19,161. There are a multitude of resistance levels above, but the support levels are quite a fair way away from the current price. Smart money will be looking at this and say, well, why should I pay here close to resistance? I'll pay down here, further away and closer to support. And that support is around 17,854, 17,321, and around the 16,500. So just bear this in mind as well. Yesterday, when we looked at Ethereum, we talked about these particular support and resistance lines. Around 1757, we have quite substantial resistance playing in that particular zone. We can see that we're about 8.7% away from resistance. And we can see support levels at 1462, which is about 9.5% away. And that 1316 level is around 18.38% away from support. My goal by going through these deep dives is to help you to truly understand how the economic system works. This is just literally scratching the surface of what we do inside the masterclass, but I believe it's incredibly important. When I was reading articles from the press, the mainstream media, I saw so little about what the truth of those speeches was. I just had to share what those speeches were all about with you, and also the understanding. Many people say, Ken, I'm not interested in government policy. It doesn't affect me. It's just all boring. Economists and people like that sitting around old tables or something. But the truth is, you really do need to understand it. You need to understand how the economy moves as one. If, for example, you don't, and you see Fed Chairman Powell comes out and says inflation expectations are just not being met. They're not going down, they're rising, and we will know that each and every day because we track it. That means that the markets will invert themselves. You have to be really careful because that will impact your portfolio. Instead, you may do something like this. Before you place a trade, you look at how Bitcoin's gravity is impacting your beloved alt, and then you look to the main market, seeking an understanding of broader macroeconomic trends. And then you look specifically at what is actually happening. But you go much deeper than that, and you understand that how things move is very important. And don't forget that Bitcoin travels 24 hours a day in every single country. It's not like the stock market, which goes to sleep most of the time. In fact, crypto is open 5.2 times longer than the stock markets. I just say that because it's important to understand. We can see that the crypto market increased 3.41% in the past 24 hours, up to 973.14 billion. I'd like to put that figure in context. When we look at the world's 100 trillion world economy, global GDP data in 2022, just take a country like Singapore with a GDP of 424 billion and then add it to Thailand, 522 billion. Crypto is worth more than Singapore and Thailand combined. Stated another way, the cryptocurrency market is worth more than the GDP of Taiwan. Put another way, it's bigger than Poland's economy and New Zealand's economy combined, or Sweden and Finland combined. It's pretty big. So when you see a figure like $973 billion, it's really good to keep that in mind as to what that actually means. And policymakers are keeping a keen eye on that as well. They want their share of the pie. Looking towards the greatest gainers in the top 100, Lunar C up 51.23%, Helium up 20%. We could see that Helium was absolutely getting smashed for the past couple of weeks. Look at it, it's come to life. USDC, the not so stable coin, up 20%, EOS 9.8% up, NEAR 9.2%, and Flow 9.2% up. The greatest losers, not too many in the top 100, OKB down 5.6%, and then we have less than 1% losses. And what are we starting to notice? The stablecoins are getting into the list of the greatest losers. Do you remember what that means? Please let me know in the comments. There were some absolutely phenomenal comments in yesterday's video, episode 646. I don't have time today, but I'll read them out tomorrow. And thanks so much for all your wisdom, everyone. And apologies about the late video. What I'm trying to do is to get more in sync with the US market, especially when we consider what is coming up with Jerome Powell. With that in mind, I'm going to be putting out videos around this time for the next week or so. Please remember to put your BORSOG code in. Do you think the market is going down, flat, or up? D, F, or U? That's the first position of the code. And what do you think the percentage probabilities are for price going against you, going neutral or nowhere, or going for you? And those percentages add up to 100%. And this last factor, there are 3 factors, not 2, not 1, but 3. What do you feel in terms of synchronization with the market? Do you think you know what the market is doing? Are you in sync or out of sync? And having integrity in how you put down your code is really important because your code only relates to you. The markets will reward your active learning. Have no doubt about it. It's the only thing that will make you money. The markets have been basically pushing a particular narrative that the Fed is not going to raise interest rates or it's going to pivot. The Fed has been saying very clearly that it's not going to pivot, that it's going to go hard. The market is not listening. The market says, oh, you're just going to do 50 basis points or maybe 25. But the probabilities don't show that. So with that in mind, take a lot of care inside the markets. Remember, we're still under resistance. When we look broadly, just like what we've been doing, we'll understand so many things other people will just be scratching their heads over. This is why persistence and commitment are so incredibly important. And always remember, if we can get on the right side of the percentage, and that's what we're all about, if we can do that, we'll be doing very, very well. And do whatever you can to get off this retail emotional roller coaster. This retail roller coaster of emotions has blame at its center. And Zone 1, Zone 2 behaviors will basically destroy your life and all the relationships around you. Please let me know in the comments, have you managed to get out of Zone 1 and Zone 2? The panic and the blame zone, have you managed to get into 3 or 4? Please have a talk about your journey. I think it would help a lot of people. And people naturally oscillate between zones as well. It takes a lot of determination and a lot of self-development and self-growth. And no blame to move out of Zone 1 and Zone 2, where people lose money, into Zones 3 and Zones 4, where we make and keep money. I'd like to thank everybody who reached out to me today and said, Ken, are you okay? We haven't heard from you. What's going on? It's very nice for your caring. I wanted to let people know just a bit of a hidden statistic. It takes me about 10 hours to do the research, to do the background information each and every day, 7 days a week, to put these videos together. And I do it with lots and lots of love. Sometimes I take some time to get back to people. I hope you understand. Please remember, crypto is volatile. Always prepare yourself for the best and worst case scenarios. Reality will likely be between them. Stay safe out there, my friends. Take care and see you next time. Bye for now.